All right, now we have a question which is question number 151 from your Kaplan kit. And the name of the question is Prancer construction. The name of the question is Prancer construction. First of all, let's go to the requirement, and we are doing the requirement number C right now. Using all the information provided, describe 7 audit risks. We have already discussed that when it says describe audit risk, that means first of all you're going to write the case study line, then you will be writing the accounting treatment if any, and then risk and effect. And explain the auditor's response to each risk. We have discussed the response thing, but for right now we'll be just writing the risk only. In planning the audit of the Prancer construction. Now, why we are just skipping the response and at the planning stage when we are doing at this planning stage is this response is very similar to the audit procedures that you are going to do after the internal control system. So when you do that thing, this thing after the procedures, it will be quite easier for you to understand. So there is a logic why we are just skipping the response right now. We can just do it, but it will be more understandable when you do it after the procedures because response is the same like the procedures. So we have to identify 7 risks from the case study for 14 marks. So 7 marks for the risk and 7 marks for the responses. You are an audit supervisor of Cupid & Co. planning the final audit of a new client, Prancer Construction, for the year ending 30th September 2007. The company specializes in property construction and providing ongoing annual maintenance services for properties previously constructed. Forecast profit is 13.8 million. Total assets are expected to be 22.3 million, both of which are higher than the for year ended 2000 previous year. You're required to produce an audit strategy document. The audit manager has met the Prancer Construction Finance Director and has provided you with the following notes: a copy of August management accounts and prior year financial statements. All right. So meeting notes, now we have to identify the risk. The prior year financial statement recognize work in progress of 1.8 million, which comprise property construction in progress as well as ongoing maintenance services for finished properties. The August 2007 management account recognized 2.1 million of inventory of completed properties compared to a balance of 1.4 million in September 2006. A full year inventory count will be undertaken on 30th September at all the 11 building sites where construction is progress. There is not sufficient audit team resource to attend all the inventory counts. Now, the first thing is that usually they have the properties which are in progress, work in progress. So work in progress is a part of inventory because we know inventory includes 3 components: raw material, work in progress, and finished goods. Now, raw material is something easily to handle. Similarly, the finished goods. But work in progress is something which is under the construction. Now, to assign the value to the work in progress or to calculate the work in progress requires the significant expertise and qualification. There's a risk that the auditor may not be sufficiently qualified to value the work in progress. And as a result, inventory may be under or overstated. Now, the previous year inventory was 1.4 million, and this year the inventory is 2.1 million. The inventory has been increased. Now, if this inventory is increasing due to the fact that some inventory is not being sold or that is slow moving, so the allowance for inventory should be recognized. If the allowance has been not recognized, their inventory may be overstated. And then there will be stock count at 11 building sites, and the audit team is not sufficient. So the inventory counts which may not be attended may have the risk of the completeness and existence of inventory. Because if the audit team is not visiting there, they will not be taking evidence. So that means that there may be an issue over there regarding the completeness and existence of inventory. So three risks in the first paragraph. So we have the first one related to the work in progress, the second one related to the increase in inventory, the third one is related to the stock counts. In line with the industry practice, Prancer Construction offers its customers a 5-year building warranty, which covers construction defects. Customers are not required to pay any additional fee to obtain the warranty. This point is related to the revenue recognition. If you understand, if you have done F7, that when you are charging for the warranties, that is a separate performance obligation, which you probably studied in IFRS 15. But anyways, they're not charging that. The finance director anticipates this provision will be lower than the last year as the company has improved its building practices and therefore the quality of the finished properties. Now, when they are offering a warranty, they should record a provision according to IS 37, but there is no need to mention the name of the standard, the number of standard, because it won't earn you any marks even if you are skipping. Like there's no problem as long as you are writing the treatment. So provision should be recorded if the outflow is probable. Now they're saying the provision will be less lower from the last year. Now if they are decreasing the provision represents change in accounting estimate. This is a change in accounting estimate. And you remember F7, which says if entity is changing the accounting estimate, there should be a genuine change. There's a risk that there's not a genuine change and the provision may be reduced to show a better picture of the profits, resulting in the understatement of expenses and liabilities. Now, the customers who wish to purchase a property are required to place an order and 5% non-refundable deposit prior to the completion of the building. When the building is complete, the customers pay further 95% and the final 2.5% due to be paid 6 months later. The finance director has informed you that although an allowance for receivable has been historically maintained, it is anticipated this will be significantly reduced. Again, the allowance for receivables. They can reduce it if there is a genuine change, if they have done something in their receivables collection. But there's a risk that those allowance may be reduced in order to manipulate the profits rather than a genuine change. Similarly, they are receiving the revenue in parts. So the revenue should be recorded when the performance obligation is satisfied. There's a risk that revenue may be immediately recorded rather than recorded when performance obligation is satisfied or the control is passed to the customer. Transfer construction prior year financial statement and August 2007 management accounts have a material overdraft balance. Finance directors confirmed that there are minimum profit and net asset covenants attached to the overdraft. Now this is something clear to us now, that they have taken the loan and there are covenants attached to the loan, conditions. If you remember your F4 paper, it says that the company can take the loan on a fixed charge and the floating charge. Now in the floating charge, they do not need to keep certain assets in the collaterals, but they can take the loan on a class of assets. In that case, they have to maintain a particular level of the net assets and the profit conditions to meet the covenants conditions. So now there's a risk that in order to meet the covenants, they may try to manipulate the profits try to window dress the net assets, as we are looking that they are just decreasing their provisions, they're decreasing their allowances. All right. A review of the management accounts show the payables period was 56 days from August compared to 87 days. The finance director anticipates that the September payable will decrease even lower. So when they're previously they were having 87 days as a payable period. Now has been decreased to 56, and 56 and it will be more lower. There may be a risk related to the cut off of the payables. Some payables may not be recorded in the correct period, as the receivable days are significantly decreasing. Why these are decreasing significantly when in fact it was 87 days in the last year? So how many risks we have identified? We started with the 3 risks in the first paragraph, then the provision, then again allowance for receivable, fifth revenue recognition, sixth, and then seventh one was they were manipulating, the risk of manipulation, and then eighth one was the payables. So this is how we can write the audit risk. Now it is also important to understand that how we'll be writing this thing in the exam. So as I said, first of all, you're starting with the case study line, accounting treatment, risk in effect. Now you have to summarize the case study line. For example, allowance for receivables has been historically maintained, but finance director anticipate that it will be, but the finance director anticipates that to be significantly lower this year. This is the case study line which we have summarized, a big line which we have summarized. Okay, so allowance for receivables can be reduced only if there is a genuine change in receivable collection or the entity is reasonably sure to collect the payments. There is a risk that allowance may be reduced to manipulate profits. Financial statements may be materially misstated. Now this is how you are going to write. In terms of response, you can discuss with management the rationale of decreasing the allowance, that what are their bases on which they are saying that they are. I told you that we'll not be discussing, but just giving you a flavor that the response is going to be Response. Discuss with management the rationale basis of decreasing the allowance. Maybe they have some, valid reason for it. Maybe they have actually done something in the receivable collection. Discuss with management the rationale of decreasing the allowance and assessing reasonableness, whether their basis or rationale is reasonable. This is going to be the response. The auditor's action in relation to the assessed risk.